All right, here we go. All right, thanks gang for joining me. Sorry I'm a minute late for my my broadcast. Appreciate your patience. So let's go ahead and dive in. It is the 3rd of August and here is my weekly market update. So what are we going to talk about today? We're going to talk about a rate update. I'm actually going to answer the age-old question, should I wait for interest rates to drop? We're going to do a quick update on forbearance and where we're at with forbearances. I'm going to talk about what the Fed said last week, really important Fed update last week. And then we're going to talk about the status of the economy, where we're at with gross domestic product. And I'm going to cover what is the difference between a recession and a depression. And then I'm going to get into some important FHA guideline changes. And I'm going to cover all of that in 27 minutes or left. Ready, set, go. All right, here we go. So first of all, interest rates today. Every week I show you the same thing. It is the exact same chart. This shows you the back end of mortgage rates. This is the value of a mortgage bond, or in other words, our cost of doing business. What I want to show you is the next slide was last week's chart. And a lot of these charts you've seen, they're red, they're green. That means they're up or down a little bit for the day. But what I really want to point out is last week, the 2.5% coupon was trading at 104.5. What that means is that the investors pay 4.5 cents extra for every dollar of money that we loan. So that's basically a lot of places that money goes. It goes to Fannie Mae and Freddie Mac. It goes to the lender. It goes to pay for me. It goes to pay for a lot of things. But basically that's what it's saying is for every dollar of loan that we give, the investor is paying 4.5 cents back to the bank. What you see today, that's at 105.25. That means that we've seen an increase of 75 cents. 75, it's 100 per $100. That's a better way to put it. 75 cents per $100. So in other words, if we loan an extra on every $100,000 that we are loaning, we're getting an extra $750 up off the top simply because of the increase. I'm trying to think if my math is correct. 1% of $100,000 would be $1,000. Yes, $750. So just between last Monday and today, lenders' income has gone up by $750 on every $100,000 mortgage they did. So on a $400,000 mortgage, we're making an extra $3,000 on a $400,000 mortgage. That's how quickly the market can change. And that is a huge increase because right here, this line right here is 104.65. That's where the market had touched way back at the beginning of July. And I was showing you guys, hey, the best numbers yet, really, really good. And then we went down and we came back up and we went down and we came back up and went down. And we have shot way past that level. This continues to affirm the point that rates should be way, way better than where they are today. What we're seeing right now on a conventional 30-year fixed is about 2.75 paying a point, maybe best case is 2.625, super, super good interest rates. You can get 2.99 without paying any points. And not paying any points is actually a pretty important thing I'm going to talk about in a few minutes. Bottom line is rates are doing really, really good and they're continuing to get better. But why aren't we seeing interest rates get better than where they are today? I'll explain it in a little more depth when I talk about my advice on should I wait to refinance or buy or do whatever. But my advice has not changed, guys. If you're looking to buy a home, lock it as soon as you get an offer accepted. It is a super, super competitive market. I don't have to tell you that. So it's not about timing your purchase to get the best rate. It's about getting whatever rate is available at the time of your purchase. On refinances, do not lock early. Do not pay for a long-term rate lock. Float because it's likely rates are going to either stay the same or go down. And I'll talk to you more about that in a minute. So let's get right into that. Should I wait for interest rates to drop? Well, let's look back at history and kind of what's happened on a couple of major events where interest rates have dropped pretty significantly in a short period of time. So the first thing I'll tell you is that we've seen two major events where interest rates dropped a lot. September of 2012. The Fed announced a policy shift, quantitative easing, and it had an immediate impact. And basically, the Fed shifted their policy to be much more mortgage friendly. And that policy shift caused a huge drop in interest rates by more than 1.5%. Happened again in June of 2016. The Brexit vote came out. Nobody expected that Britain was going to vote to leave the European Union. They voted to leave the European Union. Immediate ramifications. There was a lot of long-term unknowns, but the truth is it was one event and they knew what the outcome was, which was Britain was leaving the European Union, and they could quantify that. And that shift caused a huge drop in interest rates, again, greater than 1.5%. The most recent shift has a totally different footprint, fingerprint, whatever kind of print you want to talk about, than what we had seen back on the prior two shifts. March of 2020, COVID struck. Obviously, we know that COVID didn't strike then. You get what I'm saying. The point is, March of 2020, the economic impact of COVID-19 became apparent in the United States. But here's the difference. It wasn't an immediate impact that we knew what the outcome was going to be. It's an ongoing impact with unknown outcomes. That's hugely different than when interest rates have dropped in the past. The second major thing is rates had already been dropping for a year. If you look back at rates in the beginning of 2019 versus the beginning of 2020, rates were already significantly lower. And now we're seeing that interest rates are potentially dropping even further than where they had fallen in the beginning of when COVID happened in 2019 or 2020. And this is really wreaking havoc on the models and on the normals of, well, this is what it's normally going to look like. So I'm going to dive a little bit deeper into the normals, and then I'll give you kind of my big picture advice. The first thing that a lot of people talk about, I've covered this a few times in these webinars, but I want to remind you because the chart is colorful and it's fun. No, truthfully, it really has played out exactly as the market has expected. When you look back at history, you've got this orange line is your 30-year fixed mortgage rate, the blue line being the 10-year treasury. And you've seen that when the 10-year treasury rates go up, so do mortgage rates. 10-year treasury goes down, so do mortgage rates. And they've been very, very well connected until March of 2020. But what happened is the 10-year treasury went up a little bit, but it came back down quickly and it has stayed low. So we've seen a pretty flat 10-year treasury. The recent drop in mortgage rates is not because rates because the market conditions have improved for mortgages over the last 4 months. It's simply been playing a game of catch up. And I've been talking about this for the last 4 months, that rates should be lower than they are, and they have finally started to catch up. But the gap has mostly closed, but not completely. And I'm going to zoom in on this part right here. And so if we zoom in on that part right here, what we're seeing most recently is in July, we've seen mortgage rates stay flat. So mortgage rates have stayed around the 2.9% mark, and they've stayed pretty flat for the entire month of July, yet the 10-year treasury has been moving down in the month of July. So are we seeing another disconnect where we've got mortgage rates staying flat and the 10-year treasury going down like we had in March? Because that happened, and as soon as that happened, mortgage rates started going up. What we're seeing right now is a questionable pattern. Why are mortgage rates not following the 10-year treasury anymore? We finally started catching up, and they finally started touching each other, and now they're disconnecting again. And here's what's going on. It's this green line that's missing out of the chart you saw a minute ago. The green line is what you and I have been watching every single week for the last 4 months, and it is the mortgage-backed securities market. And what you'll see is mortgage-backed securities, the cost of the money that we are actually borrowing, has continued to drop right along with the 10-year treasury. So why haven't interest rates dropped? Because mortgage rates, the orange line, has stayed relatively flat, even though our cost of borrowing money has fallen significantly just in July. Our cost of borrowing money has fallen significantly. That has not translated to the average mortgage rate. Very simply, guys, markets saying that rates should be about 0.75% lower than they are right now. And lenders are saying, no can do. We are too busy. That is literally what's happening right now. Lenders are too busy, and there is no way they're going to pass along significantly lower interest rates. They can't even staff up to handle the amount of inquiries on refinances that's coming in the door right now. I've got some lenders that are throttling up their interest rates. I had a client reach out to me last week, and that client was getting pre-approved by another lender, got through the end of the process, and then they got their fee sheet, and it said their rate for a 30-year fixed, and they have good credit, was 3.8%. And they were referred over to me saying, John, I don't get it. Why was my rate so high? There is no good reason why their rate was high. That lender is just too busy, and they have throttled up their interest rate to throttle down the demand on their product. We're seeing it from a lot of the big banks. The big banks are saying, look, I only want my current customers to come and get mortgages from me. I'm only doing mortgages because I have to in some cases. And so these banks are not passing along the lowest possible interest rate because they don't want any business from the outside world. They only want the people that absolutely want to work with them. So the question becomes for you and your consumers, and this is really more about refinancing, but it does play into the minds and the psyche of people when they're thinking about buying a home. And as they're thinking about buying a home, sometimes they say, you know what, I'll just wait until rates get better, because maybe if rates get better, I can afford that better house and it won't cost as much money. Well, you have a couple of things in the meantime. What you've got is you've got the cost of the money you would be saving between now and then. For your past clients that you're making those love it or list it calls, remember, love it or list it. You pick up the phone and you call them, hey, just checking in with you. How's the house? Do you love it? Really? You're not that happy with it? Well, let's list it and let's get you a new one. If they love it, have you talked to your lender about refinancing in the last 6 months? If you haven't, you need to call John King. He's going to take great care of you in helping you to determine whether or not we can save you some money and have you love your house even more with a lower monthly payment. But here's the other deal. I don't know when lenders are going to be willing to allow rates to fall further. The truth is there's still a lot of people that can benefit from a refinance at current interest rates, and the housing market itself is creating its own demand. On the purchase side of the business, we don't need to lower interest rates to create more buyers wanting to buy. There just isn't enough inventory, so the demand is there. We as the lender have zero desire to lower the interest rates to get more buyers wanting to buy. There are already more than enough buyers wanting to buy right now. So that's not going to be a solution from the lender side to lower rates to spur on purchases. And on the refinance side, lenders are way too busy with refinances. They can't find enough underwriters right now. That is literally the problem. Some banks are lumping all their purchases and refinances together. The smart banks like Summit Funding, we're separating them out. Okay, as I've told you all along, we take a long time to do our refinances, and I'm happy to take a long time to do refinances because we need to focus on purchase business and make sure we're putting our resources towards the purchase business. All right, so that's really the big question is, if you wait, what are you waiting for? Because you saw it just in the last month, and I'll show you again on this chart that we looked at here. Why is this not going back? There you go. That in July, the market said rates should have gone down. The rates did not go down. So what makes you think that down the road lenders are going to pass that along when they have zero incentive to do it? They're already too busy. Here's the last thing. I think rates will drop if these figures keep staying low. If we keep seeing the mortgage-backed securities lower, sooner or later, everybody who's wanting to refinance will do it. And at that point, the lenders are saying, oh, well, then I guess we need to lower our rates so that we can bring on more business and keep feeding the machine. That's going to happen if the market stays where it's at now. At some point in the future, we're going to burn through all those available people to refinance. Then you'll see rates drop. And the cool thing is we'll probably see them drop pretty quickly to the tune of as much as 0.75% lower. We could see theoretically a 1.99% 30-year fixed, but there's a lot of dynamics that have to line up to make that happen. And here's the cool thing. Nothing stops you from refinancing down the road. If you purchase a home today at 2.99, and I said earlier I was going to tell you you could do 2.99 with no points. This is one of the reasons why I think you should be advising your clients and thinking yourself, if you're thinking about refinancing or buying, to minimize your closing costs. Because by minimizing your closing costs, if rates do in fact go lower, you can refinance again and you're not paying twice because you paid a minimal amount in closing costs. So if your option today is 2.99 with no points or 2.75 with a point, I'm going to tell you, I'd rather see you take the 2.99 and save the 1% in fee, because it's going to take about 4 to 5 years to break even. That break even basically means you spent the money up front to save on your monthly payment. How long does it take to recoup that? It's about 4 to 5 years. I think we got about a 50-50 chance that next spring or next summer, we could see a 1.9% 30-year fixed. And if we do, you're going to take advantage of it. So why would you want to be 1% deeper in the hole in your principal balance or in your out-of-pocket money? So think about minimizing the fees you pay on loans today. Think about, that means maybe not buying points and maybe not buying out of the mortgage insurance. So I'm an advocate of clients paying a one-time fee to not have to pay a monthly mortgage insurance fee. But market conditions right now say maybe that's not the smartest idea. Again, it's a case by case for the client, but big picture, I think you're better paying a monthly mortgage insurance fee. And because if you prepay the mortgage insurance, you're typically prepaying for about 3 years. And if you end up refinancing that mortgage, you don't get any refund of that. Therefore, the 3 years of mortgage insurance you prepaid is lost money if you in fact end up refinancing before the end of that 3-year time frame. So super important to be nimble with the market. My advice that I give is nimble with the market as we continue to see this play out. It is clear that things are not getting better anytime soon. And I got some information to help fill the gap on why I say that. So I'll give a quick update on forbearance. We're seeing a decline in forbearance overall, so that's good news. Here's the bad news. FHA saw an increase. So we saw 30,000 fewer people in forbearance last week for Fannie Mae and Freddie Mac loans. But FHA and VA borrowers increased by 18,000 people. Now, I think Fannie Mae and Freddie Mac is dropping so quickly because there were a lot of people that were enrolled without need. We've seen articles, they continue to pop up about people who pressed a button on the big bank's website and they ended up getting into forbearance and they didn't want it. Well, now that 90-day forbearance period's over and they're no longer in forbearance. But FHA and VA, those are more of our low to moderate income buyers, people in the service sector, people that are being impacted today. The state of California, if you didn't know it already, has furlough. You've got a 9.7% decrease in salary or decrease in pay for state workers. That's a huge cut. That took effect July 1st. So most state workers get paid once a month, which means their paycheck in the first week of July was based on June's pay. That was prior to the furlough. I want to call it a forbearance. That was prior to the furlough. But now that furlough is in effect, the paychecks that they're getting this week and next week, those paychecks are going to have a 10% lower pay. Now, there's some other concessions the state has made, so they're not completely losing 10% of their pay. But the fact is, there are still negative implications of what is going on in the economy, and we're continuing to see it. And the same thing is what the Fed said last week. The Fed has made it clear, and I'll start at the bottom here, the path of the economy depends on the virus. This is going to play out really clearly based upon how the virus goes. If the virus is resolved quickly, and I've been saying this for the last few months, if the virus is resolved quickly, the economy will rebound quickly. But we're nowhere near the V-shaped curve that everybody was hoping for. We definitely are going to be in a deeper trough. The Federal Reserve's made it clear they're going to continue buying mortgages, and they're going to continue holding interest rates super low by being a huge buyer in Treasury securities and mortgage-backed securities. But the most important thing the Fed said on Wednesday was they talked about their relationship with inflation. The Fed, for the longest time, has said they never want to see inflation above 2%. And when inflation starts going up, when they see inflation rise, and we have not seen a lot of inflation in a long time, but when they start to see inflation rise, they increase their interest rates in order to stop inflation. And the Fed has always been preemptive in that. The Fed has always said, oh my gosh, we've gone from 0.5% inflation to 1.25% inflation. We better start raising rates now. And they're raising it preemptively to keep inflation from ever getting above 2%. Now what the Fed is saying is we're not so worried about interest rates going above 2%. We want to see, and not interest rates, inflation. We want to see that the average of inflation is at 2%. That's a huge difference, guys. If we've been at 1% for a long time, and honestly, I don't know what we've been at, but let's pretend we've been at 1% for a long time. Well, then to average 2% means you could be as high as 3% for a while, and your average would be 2%. All of that is a lot of jargon to simply say the Fed would have started raising rates when inflation started getting anywhere close to the 2% mark. Now the Fed has said, nope, we're not worried about it. Even if inflation goes above 2%, we're not going to start raising rates because we're okay with it being over 2%. We just want it to average 2%. Guys, in some ways, inflation is good. Inflation is how you as a business owner is making more money because your goods are being sold at a higher price. And you want to be able to raise your prices. You want to be able to say, hey, I have a higher quality service. I'm better than my competition. My experience has grown. Therefore, I should command a higher price. But when you charge that higher price, you are the cause of inflation because you're causing goods to cost more money. And in some ways, as the business owner, as the provider of said goods, it is a good thing for your goods to get gooder, to get more expensive, for you to make more income by selling those things at a higher price. So the Fed is absolutely supporting a slower trigger on raising interest rates. And in our world, a slower trigger on raising interest rates is a super, super good thing. All right, so what's the state of the US economy? If you missed it last week, they came out with the second quarter GDP, gross domestic product. That is the sum total of all activities in the United States, all of the goods that we produce, the value of all of those goods. Basically, it's like looking at going to Home Depot every night and adding up their cash register receipts. How much money did we buy or sell here at Home Depot, but multiply that by the entire United States. And we've always seen, and we're looking back from last 4 years, a moderate increase in GDP every single quarter. And then the first quarter, we had a small decline. The second quarter was the single largest decline ever in United States history. We have never seen a decline this big in the history of the United States, and it shouldn't be a surprise. It is a huge pullback. Now, the definition of a recession is 2 consecutive quarters of negative gross domestic product. That is one definition. I shared with you about a month and a half ago, I think it was in June, that the United States had actually declared we were in a recession. And I postulated, that's a big word for today, I wondered, hey, was this, well, how can they do that? Because it's only been one official quarter. How can they say we're in a recession? And it's because I guess we have our own set of rules that in the world they call a recession 2 consecutive quarters of negative GDP. But in the United States, we have the ability to just call it and say, yep, looks like it's a recession, and we did. Bottom line is this is the biggest decrease we have seen ever in history. I don't know about you, but I've had some people asking me, well, John, does that mean we're going into a depression? Like if a recession is 2 quarters of decline in GDP and we just had the biggest decline in GDP that we have ever seen, are we in a depression? And I did a little research on it. I kind of pulled up some ideas on it. Here's the reality. First of all, the humorous answer is when your neighbor loses their job, that's a recession. When you lose your job, that's a depression. That's a joke, guys. All right, if you didn't know that, that's been around a long time. Anyway, here's the reality. A recession is singularly focused. It is singularly focused either on a particular geographic area or on a particular industry or it's not affecting everybody and everything everywhere. A depression is affecting everybody and everything everywhere. And if you look at today's economy, there are some sectors of the economy that are doing super, super well. Real estate being one of them. Real estate and mortgage are performing super, super well. Housing in general is performing super, super well. The stock market, the S&P 500 is performing super, super well. So there are segments of the economy that are performing super, super well. It's unfortunately the state of the haves and the have-nots. We're definitely dealing with the haves and the have-nots in this, but that makes it a recession because it's a downward trend that is focused on a few categories, a few sectors, and not about everything. And right here, depression characterized by sharply reduced widespread unemployment, serious decline in growth in construction, Basically, it's impacting everybody and it's across the board. We're not experiencing that. We definitely have sectors in the economy that are doing very, very well. So if somebody in a Zoom meeting, I'd say at a cocktail party, but we're not allowed to do cocktail parties anymore. So somebody in a Zoom meeting says, my gosh, maybe we're in a depression. You can tell them we're not, because a depression impacts all sectors of the economy, and we're not in that place where we're impacting all sectors of the economy. All right, I got 3 minutes left. I'm going to talk to you about FHA's changes. So first of all, FHA played a trick on us last week. They sent out a memo on Tuesday and they said, hey, we got 3 changes we're going to make, and they're all effective with notes dated today or after, which means on every one of our FHA loans, they said we would have had, if they hadn't already drawn docs, we would have to go back into underwriting and re-underwrite all of our FHA loans under these rules. And then 24 hours later, FHA came to their senses and said, oh, maybe we shouldn't do it like that. That's not fair. So they're basing it on case numbers assigned between August 12th and November 30th. So this is temporary guidance that there's a real good chance they could extend depending upon how market conditions play out. They made 3 very, very significant changes. They modified self-employment income requirements, they modified rental income requirements, and they made a change to extensions for 203K rehab loans. That third one's really minor, but I'll cover all of them for you right now. So basically what FHA said is, for self-employed individuals, and a lot of this mirrors what we've had to do on conventional loans, but Fannie Mae and Freddie Mac came out with their rules in May. Now let's think about this. The major impact of COVID started in March. The economic downturn and the mortgage meltdown, I don't know if I want to call it a meltdown, but the challenges we had started in March. It took 2 months for Fannie Mae and Freddie Mac to come out with their rules. And now here we are 2 months after that, or 4 months into this cycle before FHA is finally coming out with their rule. FHA is saying that for self-employed people, we must have evidence of current work. So executed contracts, signed invoices, something that indicates the business is operating on the day the lender verifies self-employment. Now, does that mean I have to have a contract signed the day that I'm verifying it? I don't know. FHA simply, the way their wording says, they have to indicate they're operating on the day, this is straight from their handbook, on the day the lender verifies self-employment. Some lenders are going to interpret that to say, hey, that purchase contract, let's say you're a realtor, and I'm trying to do a loan for you as a realtor, your purchase contract was dated yesterday, but I'm verifying your employment today. I'm sorry, I don't know that you're operational because I don't have a contract that indicates you're operational today. I don't think it's going to take it that literally, but that's the challenge we're going to be up against. They want evidence the current business receipts within 10 days of the note date for services performed. I don't know about you, but as a realtor, a lot of realtors don't get paid every 10 days. What if your last closing was 20 days ago? Are you going to meet that guideline, or are we going to have to deny you an FHA loan? And by the way, I won't know this until closing, because they're asking me to verify this at the time of closing. And technically it says I have to see receipts within 10 days. What if you are an attorney and you get paid settlements and you got a settlement 3 weeks ago, but you don't have another one coming in for a month? Do I have to delay your close of escrow? FHA is really particular about their wording. I'm concerned. I don't think this is going to end up being the case, but in the long term, but in the short term, you could have lenders that are reading this and saying, hey, I can't do it. FHA was clearly saying I have to have current receipts dated within 10 days of the note date. We must certify the business is open. We have to have the website demonstrating activity that supports current business operations. What happens if somebody doesn't have a website? There's some weird things that are going to play out here, but this is literally what FHA gave to us last Tuesday. And by the way, imagine how much we were freaking out when we got this on Tuesday and it applied to every single loan that we had not yet drawn docs on. How many problems were we going to run into? At least now it's only going to apply for new loans that started after August 12th. All right, I know I'm a minute over. I'm going to quickly go through these last two. Come on, computer. There you go. So this is a big one. FHA modified the rental income requirements. We must do one of these 3 things. We must reduce the effective income by an extra 25%. So by the way, we already throw away 25% of the income for a vacancy factor. So that's an extra 25% on top of that, unless we can verify 6 months of reserves, or if we can verify that you've received 2 months of rental payments in your bank statement, and that they match what you have filed on your tax return. So that is huge on FHA, that we've got to either have 2 months of receipt of rental income showing on your bank statements, which isn't really a big deal if they're counting a property that was already a rental. But if they're counting a property that, again, FHA is only primary residence. So what we're really talking about is your departure residence, the house you're moving out of that you want to count rents against. There is no 2 months of receipt because you were just living there. So either I have to have 6 months of reserves, or I have to reduce the income by an extra 25%. The last thing FHA said is they're giving more flexibility if work cannot be done on a renovation loan within the time frame prescribed. They're granting exceptions, and they're really relaxing that part a little bit and giving lenders more flexibility there. Nancy, I saw your question. I'll address it in 1 second. Guys, real quick, I'm done. I'll answer Nancy's question, but I've got 4 more webinars coming up over the next 4 weeks. I would love for you to join me. I'm going to do a market update for homeowners this Thursday. It's going to be really good. We're going to cover a lot of things about the love it or list it, things that you, what kind of market we're in, if you're having a house that you want to sell to upgrade or downsize, reasons why you should think about refinancing, and some things you need to be afraid of when you're looking at refinancing your home. So great information for any homeowners. I think you guys know a lot of homeowners because you've helped them buy their home. Talk about renovation loans next week, my 6 steps to financial freedom the week after that, and my first time home buyer webinar the week after that. So a lot of really good webinars coming up. If you have questions, post them onto Zoom chat or Facebook chat, and I will address them. And I'm going to address my first question now. If you don't have questions, feel free to listen up on the questions, and then you can bail out. What are today's VA loans? Minimum credit score requirements for vet and girlfriend. Oh, that's a great question. Okay, so VA's minimum credit score has never changed. VA does not have a minimum credit score. It's lenders that add a minimum credit score, and lenders have, all of them vary. I think we're probably on the more aggressive side. We'll go down to a 580 credit score as long as they have at least 10% down. We'll go to a 620 credit score with 0 down. So we're pretty aggressive. Again, I don't know any lenders that go lower than us, but technically VA doesn't care. VA will let us go as low as we want to go. But here's the problem of what you said. For vet and girlfriend, VA does not allow for VA's rules are different when there is a borrower that is not a veteran and is not the spouse of a veteran. So if your vet and his girlfriend are purchasing a home together and putting the girlfriend on the loan, they cannot get 0 down, because the girl, unless the girlfriend's a vet, the girlfriend is not, she's a borrower that is not a veteran and is not the spouse, and therefore the entitlement does not apply to her portion of the down payment. They have to put 12.5% down. Okay, they have to put 12.5% down if there is a non-veteran on the loan, or we don't put the non-veteran on the loan. So the girlfriend cannot be on the loan, no big deal. We'll go ahead and do the loan just in the veteran's name, but if she's going to be on the loan, then they have to put 12.5% down instead of 0 down. So hopefully that helped, Nancy. If that didn't clarify your question, feel free to post a follow-up question. Otherwise, guys, if anybody else has any questions, feel free to post them into chats. Otherwise, I will let you go. Go forth and multiply buyers and send them to me. I would love the opportunity to help them out, and I hope you all have an absolutely amazing week. We'll talk to y'all soon. Bye-bye.